Kansas City, back to Chicago, Blue Line Futures. It's the Vice President, Oliver Sloup. All right, Oliver, was the report out on Friday? Were you ready for it?
We were ready for it, really excited about it, and I think so far it's kind of played out how we expected. You get the initial trade reaction, then it's on to the next thing. Last week's price action, all in all, was constructive. Obviously, got some wind taken out of the sales on Friday, but when looking at the USDA reports, particularly this one, the USDA is really telling us a story about the past and what they found in the past, and price is really what's telling the story about the future, and that continues to be very, very constructive. We did pull back and test some big technical levels last week, but last week on a weekly basis, still positive for corn and soybeans. So the fact that December corn was able to hold that 20-day moving average on a closing basis is constructive. Now what we want to see through this week's trade is a close back above the 200-day moving average, which we're knocking on the door of. 435.5. If we get out above there, potentially we go revisit those highs from last week. Now, December, the shot clock is winding down with options expiration at the end of this week. So March contract is probably going to be where the volume starts to pick up at. And then for soybeans, a similar story. I thought the WASDE report was actually quite bullish for soybeans. We had yields lower than expected. U.S. ending stocks lower than expected. World ending stocks lower than expected. The only bearish part was the fact that China didn't show up in the flash sales. And that is certainly a headwind, no doubt about it. But like we talked about in the cattle market previously, the administration likes to work these headlines, and they know how to do that. And that does have an influence on price. So the administration potentially jawboning, future sales to China is not out of the question, and that's an upside risk. Is it, super bullish? No, not necessarily, but I think it keeps shorts at least a little bit nervous here in the near term.
Yeah, good points there. Also, I was looking at stocks to use. The ratio here for beans, 6.7%, and then 31% stocks to use ratio if you roll down to the cotton market. Definitely is going to be more than a headwind. That may be trying to drive on 4 flat tires for a while, but that's what we saw on the cotton side. Hey, Oliver, can't wait to hear your thoughts on the livestock market. So we'll take a break, be back in a moment with more Market Day Report. About a month ago, Oliver Sloup's with Blue Line Futures. Oliver, now that again, it's one thing to look at the markets and where we trade. How important is it to just step back and start seeing the forest and the trees?
It's really important. We had obviously a nice strong run in the cattle complex through much of the year, but over the last month and a half, the bears have really pounced on the breakdown that we've seen on the technical front on the back of a lot of headline risk that's been looming over the market. So I think the bears remain in control as we continue to mark lower highs and lower lows. But short term, I think there's value here to start the week. Looking at that December live cattle contract, we saw cash round out last week's trade in the mid 225s. I wouldn't be surprised to see futures go retest that. That's really where we broke down from on Thursday. From there, I think we could potentially consolidate, maybe trade up to 228 in the futures, but I think that's going to be that lower high and big resistance that we're looking at this week. So if you've got that physical risk, I think you're going to want to continue to look at any relief rallies as opportunities for downside protection. And I think the same can be said for the feeder cattle complex as well. Lower highs and lower lows has been the trend. The trading range is very, very wide there. So again, risk management continues to be very crucial. But I expect the volatility to continue in the cattle complex with the bears kind of in the driver's seat for the time being.
Okay, final one here. I want to look at the dollar index. And normally when we're talking about the dollar index, we're talking about the affordability of our commodities to outside buyers, i.e., a weaker dollar means they can buy more with less money, if you will, of their currency. But the other side of this, with a stronger dollar, it means we can buy more. Could that work its way at all into the conversation when we're talking about beef and imports and the administration? Can we work all of that together?
Well, I think there's obviously a correlation between what the U.S. dollar and commodities are doing. Now, the historical correlation for much of that has broken down throughout the year. Typically, you see the U.S. dollar retreating, and that's really positive for commodity prices. So that wasn't the case for grain markets, obviously, this year, but potentially that comes back into play. Again, headline risk, I think, regarding the South American border and the cash market probably continues to be, front and center for the market. U.S. dollar will be watched very, very closely as well, but I think it's about opening or potentially opening that border to Mexico and the administration continuing their efforts to lower beef prices for the consumer.
Yeah, good points. Oliver Slopes with Blue Line Futures, and